again, everyone. It's Vora from TradingWinds.com. And in today's video, I want to talk to you about navigating your way through bear markets. Bear markets scare most people. They don't have to be scary if you really know what you're looking for. So in today's session, I want to talk to you first about how to identify that we're in a bear market. Secondly, how to spot a bottom, how to know that it's over and that we're about to turn around. I'm going to show you a simple tool that will help you assess the current market conditions. I'm also going to show you how to gauge whether or not a trade that you're in is getting extended, and maybe you should start to exit in order to not give back all your profits. I'm also going to show you how to set up your trades for the highest probability of success and show you the one exit technique that you should never trade without. All right, so let's get to the charts here and let's start this. Now, I'm going to use Zoom as an example on a weekly basis just because it has a little bit of everything here. There was a nice strong move to the upside, a pullback, bit of a consolidation, and then a complete collapse. And within there are a lot of things that I can use as an example here that will highlight exactly what I'm talking about and how you can navigate your way, not only through bear markets, but bull markets as well. And the basics that I want you to start off with are pivots. So we all know markets don't move in a straight line. There's obviously ebbs and flows. Stock moves up a little, then pulls back, then continues up, pulls back, and moves up, etc. And it works the same to the downside, right? Moves down, moves up a little, continues lower, moves up, and continues lower, etc. So to make this as easy as possible, what you want to look for on the way up are pivot lows, which are these. By pivots, we mean turning points, right? So the market was going up, it pulled back, and then it turned back, right? So this would be a pivot high, right? It came up here. It's like it hit a wall, came back, right? Hit a wall here and bounced. So these here, this one and this one are pivot highs, right? And these are pivot lows. And then in a downtrend, these are pivot highs and these are pivot lows. Okay, so they're quite easy to spot, a little easier if we throw on a line chart than say a candlestick chart or a high, low, open, close chart. But regardless, what they are turning points. So, here we move up, right? And then we pull back and then we keep going, right? So where are the pivots? Pivot high, pivot low, right? That's simple. Here we move lower, we pull higher, then we start going lower, we pull back up, then we go lower, etc. So where are the pivot highs? They're here and here. Where are the pivot lows? They're here and here. Okay? Very simple. So in an environment where you have higher highs and higher lows, meaning from one pivot high to another, it's higher, right? The second one is higher than the first. And same with the lows. Second pivot low is higher than the first. So higher highs, higher lows. That is an uptrend. When you have lower highs and lower lows, that is a downtrend. It's that simple. Okay? You really do not need to complicate it any more than that. There will be times where you have a mix. You may have a lower high but a higher low, or a lower low and a higher high. In other words, those are times when there is no active trend. Okay, the market is usually going sideways during times like that. Okay, so for example, here we are, we move higher. This is a great example right in here. We move higher, then we move lower, right? So from this low here to this low here, we can say we have higher lows, correct? Now, look at this high here, okay? From this high here, right, we can say we have higher highs and higher lows, right? But when we make this pivot high here, now suddenly we're going lower highs. But we do not have a lower low yet, right? Until, of course, price trades below this point. So in here, we did not have a clear trend. So we cannot say we're in a long trend. We cannot say we're in a downtrend, right? It's a mixed picture. You never want to trade in times like that. You always want to sit on the sidelines. And usually these periods last longer than this, right? I'm sure you've seen channels where a stock just bounces from basically one range to the other, right? One price level to the other. And it just kind of goes like that. Sometimes it goes a little shorter in here, right? But it's just basically a consolidation. There is no clear trend there. What we want to see is a clearly defined trend, either upward or downward. Okay. Now, obviously, I have a lot of lines drawn on here. I'm going to clear it in a second, but if you need to, go back, re-listen to this, and as you're going through it, bring up other charts and practice spotting these turning points or pivots, as we call them. Okay. But remember, higher high and higher low equals bull market. Lower high, lower low equals bear market. All right. Now, once you've identified that, how do we trade them? Well, in a very simple way. There are many strategies out there you can use. We here at Trading Winds have many ourselves, but a very simple one is that when price is moving, once you've identified that, we're in an uptrend, for example, here, and it pulls back a little, right? And then once it creates that pivot, right? And it's going to continue on, you mark that previous pivot high. And once it breaks it, that's your entry. Okay. So on an upswing, right? When you pull back, you mark the pivot high. And if price trades through it, you enter long. Okay. It may go a little bit, it may go a lot. And then at some point it's going to pull back again. And you mark that high again. And if it breaks through again, you can either add to your long position, or if you miss the first one, you can get in here. And on it goes. And usually, every candle here that you see is a week long, because I'm on the weekly. Okay. If we were to go on a daily or a 1 hour or a 5 minute or 15 minute, there would be plenty of opportunities like this. But even on a weekly or monthly, these trends can last a very long time. Okay. So look at this downtrend, right? We pull back. Once we retrace a little, you mark that low. And once you break that low, you go short, right? Now, it pauses here. It pulls back. We mark that low, right? If it breaches that low, we go short again, right? On and on it goes. And here's another one, right? It pulls back. We mark that low. Once it comes down and breaks it, we go short again. Where's our exit? Well, I'm going to give you a very hard exit later. I'm going to explain that no matter what I mean by a hard exit is when you see this one thing happen, you exit your full position no matter what. All right. But what you need to do, if you just want to trail this and look for an exit, is just mark the prior pivot high. So when it comes down here, it breaks this low, so you get in again. But if it were to come up here and take out this level, you exit that position. Or you could use a moving average, and if it closes on the other side of the moving average, you get out. So it all depends on an individual trader's risk tolerance. If you are a very conservative trader like I am, you want a fairly tight stop, meaning you don't want to allow the security to retrace most of the move before you exit. You want to exit very quickly to preserve your profit, right? To hold on to your profit. If you're a little riskier, hoping for a bigger move, you're willing to give it more room, right? A bigger buffer to play with, so it can swing back and forth a little more. So what you can do is you can use a moving average. This is a 20-period moving average. You can tighten it up. You can put an 8-period, a 5-period, and that way a close on the other side of it will get you out. Or you can change the 20 to a 50 if you want to give it more room, for example. Okay, but the important thing is to know whether we're in a bull market or a bear market. I've explained that. And B, where your entries are. Okay. Now, the other thing you want to look for is how do you assess the current market condition? it's very simple. And for that, we use this blue line, which is the 20 period simple moving average. All you have to do is look at the slope of a 20 period moving average. Now, why do I use the 20 versus an 8 versus a 50 versus a 200? For me, I trade mostly on the daily time frame, and a 20 period moving average is a moving average that is used by most retail traders and most professionals. It is probably the most widely used moving average out there. So there are a lot of eyes on the 20 period moving average, and that's why I use that. It works very, very well for me. I've used it for decades, and I will never trade without it. So when it's sloping higher like this, price should be above it. And if it is most likely going higher. Because think about what a moving average is. What we do is we take the last, in this case, since this is a 20 period, we take the last 20 candles and we average them out. So if from candle to candle, we're getting higher prices, the moving average is going to be sloping higher. If we average those 20 and from candle to candle, price is moving lower, we're going to be getting a slope lower. If we're in a consolidation area, an area where it's just chopping back and forth, the moving average will most likely be flat, like down here or up here. So basically, you want to avoid the periods that are flat, and you want to trade with the periods that are sloping one way or the other. Now, how do we tell if we're in a trade? Let's say we got in down here somewhere, or even up here. How do we know if the trade is extended or not, right? Well, that's simple. How far is it away from that moving average, right? So if you look back here, it was pretty close to the moving average, right? Here it got a little wider, and then it pulled back close to it again. And then here it got very far away from the 20 and then snapped back. So one thing you can always count on is that when price moves away from that moving average, it will snap back. We just don't know when, right? And we don't know how far it can pull away before it snaps back. But one thing you can do is use the history on that chart. In other words, if we're over here and we're judging the distance we are from that moving average, we can look back and say, well, at this point it was a little further away. At this point it was about the same, right? About the same. Here was very far, but here's about the same, etc. So we can just visually get an idea of how this particular security or index or forex pair, because you can use this on anything, okay? On these methods that I'm teaching you, you can use them to trade equities, futures, forex, crypto. It doesn't matter any time frame. It's all just technical analysis. But when you look back at a chart, you can tell on average how far price tends to get from the moving average before it snaps back. So if you see an outlier like this, you see something that's much greater than normal, when it is that extended, you want to start to take some profits because you know sooner or later it is going to snap back. And the more parabolic the move is, meaning the quicker it moves away, the quicker it is going to snap back. Okay? So that is very, very key. The spacing between the moving average and price. And you always notice when the first crosses, obviously they're together, then they start moving away, comes back a little, starts moving away, comes back a little. When it goes far away, you know it's going to snap back. So instead of trying to pick the absolute top or absolute bottom, you want to start to scale out, okay, and maybe tighten your stop. In other words, if I was using a 20 period moving average here for my exit, let's say I was deciding that once it came back here and closed below, I was going to get out. But once I saw it separate this far, I would tighten it up, meaning I would go from, say, a 20 period moving average to an 8. Let's see. Actually, let me just add a different one on here. What is this one? Let's see. This is a 10 period. Okay. So let's put this on. And you see how much tighter the 10 period is, right? In white. So you see the 10 period would have got us out up here whereas where the 20 would have been down here. So we would have preserved more of our profit. Okay. Now, the downside to using a tighter moving average when it isn't very far from that 20 is that it could come in and take you out prematurely, right? Get you out. I mean, you can always jump back in, but you'll be in and out more often, right? The 20 is a good medium term moving average, so it'll give it enough room to let it play out. But once it moves out far away, expect a snapback. Okay, so we know how to spot bull markets. We know how to spot bear markets. We know what to look for with those pivots. We know how to enter our trade when it breaks out to new highs or new lows, etc. Now we know how to tell whether the trade is extended a little or not, right? Now, how do we gauge when we might be at a market top or market bottom? And here I want to focus on market bottoms. So think of it. Based on what I just explained to you, common sense would tell us that if we have lower highs and lower lows and we are in a downtrend, the one thing that would immediately get our attention is if price made a shift and all of a sudden we had higher highs and higher lows, right? That shift from lower highs and lower lows to higher highs and higher lows would be or should be a green light for now for us to say, hey, we are no longer in a downtrend. We are in an uptrend. Okay? At a minimum, if you shift from lower highs and lower lows to higher highs and higher lows, you should exit any short positions you have, right? Forget about going long at that point, but you at least have to close your exits or your shorts, excuse me, right? And so using Zoom as an example, let's zoom in here a little more. Pardon the pun. We have high here, high here, high here, right? And high here. So we still have a series of lower highs, correct? Now, where are the lows? Low pivot here, low pivot here, low pivot here, low pivot here. We still have lower lows. So can we say that this has bottomed? We cannot yet, right? We need higher highs and higher lows. Now, can we call this one here a pivot low? We can. If it takes out this high, we can. So then we would have higher low, right? And if it takes out the prior high, then we would have a higher high, right? So from one low to the next and from one high to, when price overcomes this level, we would have a higher high, right? So now if price starts to do this and overcomes that level, we will be able to say higher lows and eventually higher highs. And at that point, we want to, at a minimum, exit our short positions. That's how we know that it's bottom. Now, is it 100% foolproof? No, it's not. Of course not. It could just come up here and then roll right back over. Correct? So what else could we possibly use to sort of stack the evidence in our favor to convince ourselves that the bottom is in and we're only going higher from here? Well, you can incorporate specific charting patterns, right? One of the most common and one of the most reliable chart patterns that you will find in both tops and bottoms are what we call a head and shoulders. Okay, so what you want to see is something like this, right? So if price had moved here, right, bounced back, moved here, right, bounced back, moved here. Actually, I drew it incorrectly here, this one. Let me get rid of this one here. I should be going through that, right? And then, oops, lock it in. Come on. All right, let me draw another one here. And then it goes up, creates that pivot high, and then comes down. So you see, shoulder, head, shoulder. That is a topping formation, okay? Now, what you would do is you would take the lowest point between the two shoulders. So anywhere between this level here and this level here, you would look for the lowest point in between there. In this case, it would have been here. You would mark that. And if price went below that, that would confirm that head and shoulders. So the opposite of that is what we would call a reverse head and shoulders. And that is when price comes down, pivots, so it makes a shoulder, then comes down a little lower, right? That could be your head, that pivot. And now if it comes up, pulls back again, and makes a higher low pivot, now you have the opposite of this, right? You have a reverse head and shoulders. What is the highest point between the two shoulders? It is that level we were talking about before, right in here. So now, not only do we know that if price gets above this level, we'll call it 127 or so on Zoom. If it gets above that, not only do we know that we will have higher lows and higher highs at that point, we will also know that we will have confirmed a reverse head and shoulders pattern. Okay, so that stacks the evidence in our favor that we should be going higher. The other thing you want to do, another very, very simple trick, is to use a simple moving average. So if we're going to use the 20-period moving average, all you need to do whenever price crosses that, okay, is to look for it to break a pivot after it crosses. Meaning, here, once it moved from below to above, you want to look to your left and identify where's the pivot high that's above there, right? So it was here, right? So we draw a line. So you can take the cross here. You can enter on a cross of the moving average. But if you don't look for a break of the prior pivot high, you're not going to be nearly as successful. In other words, many times it'll cross and then cross back and then cross back above and then cross back, right? A choppy period will eat you up. You will get in, stopped out, get in, stopped out, get in, stopped out, and it'll just take all your money. So as a way to confirm that things have rolled over and turned around, you want to wait for it to take out that previous pivot, right? So if we look at this example, we had a pivot here and we also had another pivot here, okay? Now, we can draw that as one line because they're pretty much in the same spot, okay? Or we can draw them as two. But that is also known as a double bottom, right? A double bottom. Now, how do you confirm a double bottom? You take the highest point between those two lows, which would have been here. So even early on, we could have looked at this and said, if price gets above that level, we have a double bottom. Now, here's where it would have happened. What could we also say at that point? We could say that we are also above the 20-period moving average. Well, what does price normally do when it is above the moving average? It goes higher. What does it do when it's below the moving average? It goes lower, right? So we already had an indication here that we had found a bottom and we're turning from a bear market into a bull market. What else could we use? Remember the basics. Higher lows and higher highs. If you could say to yourself here, we have higher lows and higher highs, then we're good. Now, these lows look like they're at the same level, but in fact, this one on the right side is a little higher than this one. So in fact, we had from this one to this one, higher low. And once we broke this level, we could say we had a higher high because this pivot here, and once price went above it, wherever that next pivot's going to be, it's going to be above this one, right? So we had a double bottom confirmed. We had price crossing the moving average, right? And giving us higher highs and higher lows. And then when it crossed that moving average and we look back and it takes out the main pivot, at this point, if you didn't get in anywhere down here, you had to get in up here. And here's something else. When you get in here, what is the 20-period moving average doing? It is sloping higher, right? Remember, you don't want to trade during flat periods. You want to trade when it's sloping. In here was a perfect entry on Zoom. And look what happened next, right? There you go. Now, look at this area. Pivot high, pivot high. Could that be a double top? Yep. When would it be confirmed? When you take the lowest point between those and price breaks down, right? It breaks below that. So at this point, It was below there. It confirmed the double top, correct? Now, if you hear coughing in the background, that's my dog. So excuse me. He's okay though. So right here, we are below the moving average now. We are confirming a double top. And if we cross the moving average, what do? We look to our left and we look for a major pivot and we look for a break below, right? Right here. So once it got here, boom, right? If you didn't get in here, you had to get in here, right? Short. So this is how you read these charts. Very simple. Okay. And then once you're in that trade, you let it do its thing. Remember, looking for these minor pullbacks and new entries, minor pullback, new entry, etc. And you keep an eye on the distance between price and the moving average. And if it ever gets more extended than usual, right, you kind of tighten up your stop and you try to preserve as much capital as you can, or as much profit, along the way. Okay. And now, second last, how do we set up our trade? Okay. So let's say right now we believe, I'm going to zoom in here a little. We believe that if Zoom crosses this 127 level, we have everything that we need to be convinced that this is going to go on a bull run. Okay. Now, we might not have a sloping 20 in our favor yet, but let's say that the head and shoulders, the fact that we're, on the north side of the 20, the fact that we're going to have higher highs, higher lows is enough evidence for us to take that trade. So let's say that, price comes and crosses that level. How do we set up this trade in a way that will allow us to take advantage of whatever upside there is without risking too much? Because I hate risk. I absolutely hate risk. What you want to do is this. When it crosses that level and you go long, you buy at that level. You again look to your left and identify the most recent pivot low, which would be this candle right here. And that is where you put your stop, your initial stop. So you need to assess your risk. If we're looking at 127 as our trigger, the low of this candle is 102, right? So is that too much risk for us, or is it enough risk for us, right? That's what we have to decide on. If it's too much, we skip it, we go on to the next trade. If it's within our risk parameter, we take that trade, but we set that up. And so let's say we enter here, okay? We put our initial stop right here. Now, the trade starts to move, starts to go in our favor, right? Pulls back a little, right? Now, remember, what do we do when it pulls back? We mark this high, right? Because if it comes back and takes out this high, we're going to add to our position. Or if we hadn't taken the trade here, we have a new entry here. But what we want to look for on the pullback is where it may create a new pivot. Because if it comes all the way back below this candle here, we're going to get stopped out, right? Remember, our stop is here. But let's say it comes back a little and then starts to move. The second it creates that pivot and starts to move higher, we move our stop from here to here, okay? And if it moves above here, we add to it or we open another trade. And if this was a new trade, if we had not taken this one and we enter on a move above this pivot here, our stop goes just below this pivot. That's our starting point, right? So entry, stop, and we assess our risk level, okay? And on and on and on. It really is that simple. Lastly, one more thing. Let me remove all these drawings and bring in the full picture. The most powerful exit you can trade with. The one thing that if you ever see this, you need to exit, and not just exit part of your position, you need to exit your full position. And that is simply the 20-period moving average. Okay, a simple 20-period moving average based on the close. In other words, you can look at any chart you want. The vast majority of the time, if price is above the moving average, it's going higher. If it's below the moving average, it's going lower. If the moving average is flat, you don't want to trade anyway because it's chopping around. Okay. But if you're in a sustained trend, up or down, and you get a close, not a trade, but a close on the opposite side of that 20-period moving average, you want to get out of that position, your full position, and keep whatever profits you have. It doesn't matter how strongly you believe in a company. I always like to use the example of Apple, right? Apple makes money hand over fist. They have a great product line, okay? They have more cash on hand than some countries' full GDP. I mean, they could buy other countries with the cash they have on hand. If you look at the health, financial health of companies, there is no better example than Apple out there, in my opinion. So in a situation like that, you'd think that the only thing you should ever see with the stock price is that it goes higher. I mean, if they keep making money, they are financially sound, people love their products, they're going to keep buying their products. Why would you ever want to sell Apple stock, right? But the reality is that the stock price does not always reflect what the company is doing. In other words, in an environment where the overall market is going lower, it will usually drag down all stocks, even the good ones. So it doesn't matter. So during a move up, if you're on the right side of that 20, you can feel comfortable staying in. Once it closes on the opposite side, you want to get out. Okay. And sometimes, yes, you'll get out and then it'll cause you to go right back in, out, right back in, right? Here it didn't close there, but even if it did and it closed right back above, you get right back in. So there may be times where it gets you out and then back in. What that's costing you is only a few extra dollars in commission, right? That's all it's doing. But what it will save you from is that time where that uptrend ends and a downtrend begins. And whether you love the company or not, you don't know how far back it's going to pull back, right? Apple so far has been one of the best performing stocks in this current market, where most are down much, much more, but Apple's holding on. But now you can see it's broken. And here's a classic head and shoulders pattern, broke the midpoint low here, and is really starting to fall off a cliff now. But the point is, had you gotten out at here, you would have preserved your profits, right? You would have saved, you would have kept those profits. All right. Whether you went short or not, whole different story. But you would have maintained what you made already, right? You wouldn't give it back just because you love the company and are hoping that one day it's going to turn around and go back higher, right? Remember Peloton? Everyone loved Peloton during the pandemic, right? Look, if it closed below the 20 you got out here, you would have kept all your profits. If you didn't, look where you'd be now, lower than it ever was. It's at an all-time low. And I can go through dozens and dozens and dozens of these examples. Literally hundreds out there, just like this. And it happens over and over and over again. So if Peloton, if you're short Peloton, and it ever closes above the 20, close that position. If you're ever long and it closes below, close that position. That to me is a hard exit that you should always adhere to. Okay? So, in a nutshell, what I've given you today can be used for both bull and bear markets, but most people have an easier time trading bull markets than bear markets. Don't let it intimidate you. Sometimes they happen a little quicker than bull markets, but it's the exact same analysis that you should be doing. Look for lower highs, lower lows. Look for breaking, for times where it breaks a prior low for new entries. Look at the distance from the moving average to assess whether it's extended or not. Look for a shift from lower lows and lower highs to higher lows and higher highs as confirmation that the downtrend is over and that we're about to start a new bull trend. At the same time, look for major charting patterns like a reverse head and shoulders, like a double bottom, okay? Look for something simple like price moving from one side of the moving average to the other and taking out a prior pivot high, all right? Set up your trades in a way where you're being smart. meaning you're going to give it room to run, but your stop is just below the most recent pivot low, meaning if something happens and it reverses course quickly, you'll take a small loss, not a big loss, okay? And remember the hard exit, the 20-period moving average. Whether you're long or short, if price closes, not trades, but closes on the opposite side of that moving average, you want to close your full position, okay? Thank you for joining us. I really hope you make use of this. Watch it over and over again if you have to. And if you have any questions, drop us an email at info@tradingwins.com, and we'll see you on the next video. Thanks.